This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the year ending 2018. Trading session is now over. Today is Monday, December 31st, 2018, so we've officially closed out trading for the year. And I wanted to go over, I'll keep this video brief, or later in the week, maybe I'll do a longer term outlook for the market. Let's just take a look at the near-term outlook, some near-term levels to watch, and what we might expect later this week and heading into January. Um, I'm still near-term bullish. I still think the risk-reward, even though we've had a nice snapback rally off the lows, of course, we've already come up about from high to low. From that was Friday's high, about almost 8%, 7.5% on SPY, and we're still up about 7 right now. So there's a good part of the double-digit snapback rally I was been talking about for over a week now. That when we get a rally, it'll probably be measured into the double digits, and we're not there yet, but getting close. Now, we'll take a look at a couple things here. And first of all, we had on the weekly chart, we still had the divergences intact on the RSI. We burned through the divergences on the PPO, although, as I say, divergent highs aren't a requirement for a correction. Divergent lows are not a requirement for a bottom or a rally. So far, that is, we're starting to see a rally. Here's that big divergent high we had leading up to the correction. I don't know where that line went. I wanted to just put it back on there. But let's go ahead and take a look at the charts real quick here. So starting out here on the daily time frame, this is SPY. We closed the day up almost 1%, 0.96. Nice gain today. Remember, volatility will eventually abate sooner or later, but as of now, you still need to expect these big, intraday price swings of 1% or more. We certainly saw quite a bit of that today. But at the end of the day, all that really matters is how does the market close. And today we closed up about 1% on SPY. Let's look at QQQ. QQQ was up 0.84. The chart looks very similar, so almost a 1% gain there. We'll look at the mid caps, MDY, up 1%. And then, of course, IWM, small caps up about 0.8. So across the board, we'll call it about 0.8 to 1% today. And again, let's not try to read too much into this. But what I'm seeing here is, again, it's a market in accumulation recently. This was a market in distribution. There was a lot of forced selling, people panic, redemptions from mutual funds, ETFs. That leads to more selling. And again, it was all part of the overcrowded indexing FANG trade. And so far, we're seeing signs that, at the very least, we can say over the last week that the near-term trend has turned to bullish. And more importantly, again, this was the waterfall sell-off right here. This was forced selling, panic selling, and now that that's over, I think it will continue. I see a lot in the charts. I see the PPO turning up, poised to make a bullish crossover. Again, that's just IWM. Let's focus on the large caps here. Same story. PPO is starting to turn up, and let's look at the intraday charts. All right, so this is the last update on Friday. I mentioned we had this downtrend line in SPY here, as well as an uptrend line just below. And so I showed a couple scenarios, come out, break above here, and that's what we did. We broke out today. This was today's trading. We broke out, we back tested the downtrend line all day, came in, tagged the uptrend line, and that's where we closed. Last candle, you can see it hit that uptrend line. And I still expect a continued move up here to at least 253.51 in the near term. So that would be a target for Wednesday when trading opens up. And keep an eye on this trend line. There are some developments, and I'll point that out we'll get to the futures as well. I believe I pointed out last week. You can see the PPO has made a very strong move, very extended. You can see the PPO from this low down here all the way up here without a crossover yet. So it looks like it's poised to make a bearish crossover. You can see, although we had so much volatility in the last few months, you don't see such a stretched, such a strong move in the PPO. Maybe we get a bearish crossover, but again, I'm leaning towards a continued move, even if we break this trend line. I'm just giving you levels to watch. What I think will happen, and I did a video today earlier, midday update for members of the site, highlighting this, that if we do break down I suspect that it will be a very brief and shallow breakdown if we break this sometime this week, and it will probably prove to be a bear trap. Whereas as soon as we break down shortly after, we'll probably move back up and continue to rally from there. And again, these are the levels to watch, about 250, 350, and ultimately I think we work our way up here to 260, 223. If and when we get there, or as we approach that level, I'll, continue to look at the charts and see if we're going to make it all the way up here. This would be at this point in time my uppermost bounce target right now on the S&P 500, and that's that really pretty much a triple top high that we had in October, November, and early December right there. So let's just say my minimum bounce target right now, maximum bounce target, and again, I always say this, the charts are dynamic and therefore so is my analysis. So if something changes, I'll let you know. But as of now, I continue to view any pullbacks, as I stated on the site today, as buying opportunities. We had a buying opportunity today after the market pulled back to test this trend line. It also backfilled the gap on the futures. I'll get to those in a minute. I'm talking about the weekend gap. So there's SPY. QQQ, same story. We took out the trend line. You could see this morning's candle. We had a nice move up. They faded it in the day, but the buyers stepped back in. And although from there we mostly sideways trading, I don't want to try to read too much into that. But again, this is the important thing. You can try to decipher what all this means. Look, it was the last trading day of the year. And I said this on the site this morning, expect a lot of volatility, intraday price swings today. You have tax loss selling, you have window dressing, all kinds of shuffling that goes on the last trading day of the year. But most importantly, we close the day green. And it just shows, if nothing else, that the forced selling and the distribution mode the market was in, at least for the time being, has ended. And that's a good sign. It can certainly lead to more upside, I think. And if not, keep in mind, this market could run down. My primary scenario, I think I've made it pretty clear now, is near-term bullish. But my alternative scenario would be this, and I put a pretty low odds on it based on everything, including this big green candle. There's a lot of evidence that we put in a selling climax here. But should we get a big thrust down later this week or early next week, at most I'd be looking for an undercut of the recent lows, or maybe a roughly equal test, call it around, maybe a little above, a little below. And again, that's a worst case scenario, and I would have to put, I don't know, I'd say more than 10, 15% chance of that, if that, probably less than 10%, and better than 70, 80% that we're going to rally from here before we even come close to those lows, that we're going to continue to rally. And then whatever that extra 10% or so, that's just something plain wrong, and this market's going to crash. I don't think this market's going to crash right now. Things that I mentioned in the video earlier today, I talked about things like industrial production. There's a lot of economic indicators right now that are strong. The economy's strong. Again, this sell-off now. Don't get me wrong. I still believe the market quite likely put in a lasting top. Can't say, you can never say anything with certainty, only in hindsight. But I think this is probably a bear market rally we're looking at here. But whether it's 10, 15%, 18%, you certainly don't want to be on the wrong side of it if that is the case. But what I was getting at back here, from 2000 and early 2000, beginning of 05, leading up to the top, if you recall the market top, and again, I covered this in the video for members. I just want to touch on this for those that on the YouTube channel. The last bull market peaked in 2007. Remember, we're not looking at a chart of the stock market here. This is industrial production, one of many economic indicators, one that I follow. And you can see that it was already trending lower. There were a lot of indicators. The economy was rolling over. We had a huge housing bubble. I think housing prices are frothy now. I think they'll be coming back in and all that. But we also had, a credit bubble that, when it broke the banking system. I think we have a credit bubble now. I think this one will just take a lot longer to unwind. I don't think we're going to see a 2008 type meltdown again. That's just my guess. I'll take it as it comes. But I wanted to point out that a lot of economic indicators were trending lower back then, leading up to the market top. This is where the stock market peaked. This time around, a lot of economic indicators are strong and employment's low. Let's not discount, I'm certainly not, this plunge in oil prices, by the way. Um, this is a tax cut. I forget what the no, not a tax cut, a boost to the economy, a boost to GDP. And I forget what the numbers are. I've heard it in the past where when oil prices drop by X amount, what the boost is to GDP, because that is a huge boon to a lot of companies. You're going to see transportation stocks benefit from this, and just about everybody, consumers, of course, from the falling oil prices. So obviously, it's not good for the energy sector, given, and the financial markets are complex. So for every plus, you can look at the other side and say, well, this is going to cause some of the E&P producers, the oil and exploration production stocks, frackers and companies like that. You'll see some of those go to the wayside. But remember this too, we already had a washout in oil prices back here. So a lot of the companies that were already weak washed out then. And don't get me wrong, we'll probably see some additional ones go there. And yes, that has an implication on some banks or whoever, individuals, whoever has, has lent money to those companies. In other words, the bonds or creditors. But for the most part, I think this is a net plus. Let's just leave it at that, a net plus. So going back to the markets, so there was SPY, there was a 60-minute chart. I showed you targets. Again, my scenario, work our way up here, and then QQQ. I think I already showed you that. No, maybe I didn't. I covered this last week. We're talking a move up. Here's that trend line to watch. We broke out today the downtrend line. Again, we have intersecting trend lines. We have a downtrend line and an uptrend line here. So as long as we remain above this uptrend line, and again, I'm very open to and actually favoring at some point before we get to 120, 160.20, I think we'll break this trend line. I think it'll be a quick, you'll see high frequency trading, the bots pile in, the shorts try to pile in, and then I think you'll see a reversal and a gun up here. So as I said in the video to members today, if we get a breakdown and we get some impulsive selling, I'll probably buy into that breakdown. And then, with a stop somewhere below, you can't go crazy. You might have a scenario what you think the market will do, but that's any trade. You go long if that's your plan to buy pullbacks to this trend line or short an impulsive breakdown of it with a stop somewhere below. I think the risk reward is attractive because if we do get a reversal and pop back above that trend line, that would be a bear trap. All those shorts would realize they were wrong. They'd be squeezed out. They'd start to cover. The machines take over. They smell blood. They're like sharks. I'm talking about high frequency trading. I'm talking about the algos. When they sense that shorts piled in on a technical breakdown, they see the same levels we do. And there's a little flag too, by the way. So that's one of many scenarios, but the bottom line is I'm not trying to get cute in gaming all these pullbacks here. I've stated, that, I'll just use pullbacks to support as opportunities to add to long exposure until and unless the technical outlook changes. But I'm not interested right now in trying to short this market at this point in time. If something changes, I'll let you know. So that target at 160.20, by the way, similar. We have this triple bottom low right here in QQQ. It was broken right here, and then we back tested it. So I think that's a pretty solid number, pretty solid level. And when I see a very well-defined resistance level like this, and you get close to it, it's almost like a magnet. So I think the closer we get to that, the greater the chances are we'll hit it. Well, of course, that makes sense. If we get closer to it, the odds go up that we'll hit it. But anyway, either way, that's the target I'm looking at right now. Let's see what happens here. We get these bearish crossovers again. Normally, I might be overly concerned with that, and I'll certainly respect it. But I think, it's not going to spook me out of my longs, is what I'm trying to say. I think if we get a bearish crossover, maybe it comes with a breakdown there. That would also trigger a lot of shorts to go in on a bearish PPO cross. But right now, the PPO is above the zero line, which is in bullish territory. You can see we've crossed over here when it's down below, and I like to use this 9 EMA, the signal line. That's the white dotted line. When it's below the zero line, the trend is bearish. You want to be short. When it's above the zero line, the trend is bullish. So there it is, bullish bearish. Most of the time for the last couple months, it has been below. It's been bearish, telling you to be short. It's just a short-term indicator, one of many that I'll use, but so that's that. That's the near-term stuff. Let's look at the futures, and we'll wrap this up. Let's see. Okay, this is NQ. And I mentioned last week and again in the video earlier today that I would be remiss not to point out these, almost textbook looking bearish rising wedge patterns. And this is where my trading style might differ from many. You read trading rules, this and that, and they say, trade the charts, only go by the charts. Some people are mechanical traders. They don't deviate from the charts. I take everything into account. I'm putting a higher weighting on what's happened on the daily time frames and the weekly time frames, the extreme oversold conditions, the recent bullish price action we've seen, the potential selling climax I talked about on the daily. Therefore, I am willing to hold tight, as we get towards the apex of these bearish rising wedge patterns on the futures. If I didn't make mention, that's NQ, the NASDAQ 100 futures. You have negative divergences, everything I normally like to see. So if I would have seen this bearish rising wedge pattern up here or somewhere up here, that would have been a short signal. But at this point in time, like I said, if we break down, I suspect we'll get a false breakdown. And there's also another possibility. Maybe this upper line extends. Maybe this morphs into a price channel like this. These divergences certainly have room to either continue higher and remain intact and then play out at a later time like this. Let's say we move up, or maybe they get burned through. But as of now, I'm favoring more upside here, and we'll watch if that something happens next week and we melt down, and maybe we go into that alternative scenario where we come in and retest these lows, maybe undercut them. That's a possibility. I can tell you this. I will not be in the trading account. I will not be long all the way down there. IRA long-term stuff that I've scaled into over the last week or so, no problem. Right now, I don't see anything in the charts that will spook me out of those positions. If that changes, I'll let you know. Even a flush down to come in and test these lows again wouldn't do it. I would just probably can't tell you if I deploy. I'm not. I think I'm roughly. I think about 75% net long. Well, it's all long in there. There's no short positions in 401ks or anything like that. But that's what I'm looking at is let's say my most bearish scenario. It's still bullish overall, and again, I'd put less than maybe a 10% chance that happens. So right now, this is what I'm looking at. Target zone on the futures right here. Anywhere minimum this 64.70.26 up to about 65.53, and then it gets kind of tough. Just like on QQQ, we get into a pretty significant resistance zone. Let me just go back to QQQ for a second and show you something here. Let's see. Okay, this chart. So what I think will probably happen, if I'm correct on this, and there's a little more upside here, up to about this 160.20 area, we continue on up here, get up there, quite a bit of work to be done at this point. I think especially if it happens soon over the next several trading sessions. Remember, the markets will be closed tomorrow, open up on January 2nd, Wednesday, and so if we popped up there quick, we'd be pretty stretched in the near term, and there's quite a bit of overhead resistance, so maybe some consolidation, and this might not be a bad time to either stand aside. I'll have to view it. I'll probably stick with swing longs at that point, but an active trader might want to step aside and maybe just go into day trading mode or something, because I doubt we're going to just go up. If I am right and we're heading, if this market has another 5 to 10% upside left in it, it's not going to be straight up. I really doubt that. Anything is possible, but I think a lot of the easy money has been made over the last several days here. And then the same thing with SPY. SPY has a little bit of upside to go until it hits that key level. Remember these lows right here, three major lows. up around 263.23, and from there it might be tough sledding. We either get a pullback or I favor consolidation more than a deep pullback at that point. That's today. Today is Monday, the 31st. Wednesday, Thursday, Friday, I may be singing a different tune. Let's see what happens. But as of now, that's my outlook for the market. And we'll wrap it up here with ES. I showed you NQ a minute ago. NQ is the NASDAQ 100 futures. These are the S&P 500 futures. Virtually identical rising wedge pattern, negative divergence, everything a bear loves to see. But right now, I'm tilting towards, let's say I'm cautiously bullish. I remain cautiously bullish at this point in time. The markets are still in a very precarious technical posture. They're not, relatively speaking, they're only one or two, a couple bad days off the lows. I mean, we can certainly take that out in one or two bad days. So we're far from out of the woods yet. But I'm still favoring to work our way up here. And you can see on the futures, we start running into resistance right around here at, what is that, 25.94. We have a reaction there, reaction there, all the way up here at about 26.26. And you can see the reactions there. So this is my near-term bounce target zone on ES, which should correlate with those bounce target zones on SPY and QQQ that I showed you a minute ago. And again, you want to watch this trend line. I would not be surprised in the least to see this trend line break before we get up here, but I think any break might be and then we'll really know the character of this market, by the way. If we get a breakdown over the next week or so below these trend lines in SPY, QQQ, ES, and NQ, they all, come in together. If we get a breakdown and you start to see impulsive selling, and then it gets bought up and we snap back above the trend lines and the buyers step in and overwhelm that breakdown, that will again show you a change of character in the market. It will show you that the buyers are now in control. It hasn't happened yet. I'm just laying out a scenario. So if you watch it and you see it happen, you see the breakdown, you see a reversal, you get back above there, especially if you take out the recent highs, that would be quite bullish. And it might open the door for a quick trade if you're not already long, or if you want to stay long or add to your longs up to that target zone. And if they somehow blast through there, which is certainly a possibility. Remember, we're very oversold. This was more of a forced liquidation type sell-off, in my opinion. There's certainly some of it accounting for the fact the economy is turning, eventually is going to be heading into a recession or slow down. There's all that, but that's, I think, been priced in, and then some for the very near term. I'm only talking near term here. I'm not talking a year out. I'm looking out right now, 4 to maybe 8 weeks in the market. And, so at most, I told you this is my preferred swing target zone right now, near term. And at most, if things get if we really start to rocket, this first week in January coming up, look to maybe a move up here at about 26.85 or so on ES. All right, well, let's wrap it up here. We'll pick this up on Wednesday. We'll see how the markets open up, first trading day of the year. Remember, volatility is still high. Markets are still in a precarious position. Anything can go. But as of now, like I said, I like everything that I see. I think looks good for more upside in the coming weeks from here. This has been Randy Finney with Right Side of the Chart. Happy New Year to everybody.